This video reviews possible areas of overhead resistance should the S&P 500 rally back toward the 1050 to 1200 range. We will also update several long-term bearish signals as of the close on September 22nd. We will examine several stock markets around the globe, the Australian dollar, gold, silver, and crude oil. As we head into a new trading week, this is a 60-minute chart of the S&P 500 index as of Friday's close on September 23rd. Takeaways are simple. Here is a bullish trend line that held here in this basic area here, here, here. And these are similar trend lines. As you can see, we broke these two trend lines here recently, last week, when we came down in a bearish manner. So what once was support in these areas now becomes potential resistance here and here if price can make its way back up. Typical retracements, we moved 106 points from here to here last week. Typical retracements are these levels. This is 38.2% of 106, takes you back to 1154 on the S&P 500. A 50% retracement takes you to 1167. And a 61.8% retracement of this move would take us back to 1180. These would all be typical retracement levels, and these are areas where traders may look to sell into the rally. We've also got various pink trend lines here that have bounded the market in various ways in the past. There's a cluster of them here between roughly 1148, which is this green line, and maybe let's take it up to roughly 1180. So if we were to move back up, it wouldn't be surprising at all to move back towards these levels. We could even move all the way up here and still have this downward sloping trend line remain intact. This is another relatively short-term look at the S&P 500. The last chart was as of Friday's close, and it was a 60-minute chart. This one's a daily chart. So it simplifies it a little bit. Here's the bullish trend line that held here, 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 and here. What once was support now becomes resistance. These two candlesticks that intersect here at roughly 1165 on the S&P 500, that represents a spot where we could run into some resistance if we come back up, and sellers may become a little bit active at 1165. Here's the last two lows that we made. So if you draw a trend line here in blue and put in a parallel trend line here, you'll notice it tends to meet in this same general area, a little bit above, maybe 1165 to 1175. You can see price was bound here by this dotted trend line here. You can see there was a little bit of clustering in here. Point of the exercise is similar look. There's potential resistance in here. This pink trend line could be resistance, and this second blue trend line. The other takeaway is these are the 100-day moving average sloping downward. The blue line is the 50-day moving average sloping downward. The red line is the 200-day moving average starting to roll over here, sloping downward. These are indicative of bearish short-term trends, and these are much more indicative of what a bear market looks like rather than what a bull market looks like. This is a very long-term chart of the NASDAQ composite going all the way back to 1992. The tendency is when the 6-month moving average is over the 13-month moving average, as it is here, red over blue, that's bullish, and you try to err on the side of staying with a bull market. Here you get a bearish cross of the red line going below the blue line, and here you give the bear market the benefit of the doubt. There's a buy signal, nice bull market, sell signal, bear market. It held here in 2010, and currently, and we're not done with the end of the month yet, the NASDAQ could rally and wipe this out, but as of the 22nd, the 6-month exponential moving average is below the 13-month exponential moving average, which means we're looking more and more like these two periods here. Some other takeaways. Notice when this bear market started, you got some high volume sell-offs here. Same thing here. When the bear market started, you got some high volume sell-offs. Looks like a new bear market, and we got a huge volume spike in here. This is the MACD indicator. You don't need to know anything about MACD other than when black is above red, that tends to be bullish, and when black is below red, it tends to be bearish. You can see we got a bearish cross here and a bear market. We get a bullish cross here, a bull market. Bearish cross, bear market. Bullish cross, bull market. We now, again, this needs to hold into the end of the month, but you can see here, 138, the black line is below 151, the red line, which means the NASDAQ is starting to look a lot like these periods here. Since Europe tends to be the epicenter of deflationary and debt problems, let's take a look at the Euro Stoxx 50 index, which is a good barometer of the general health of European stock markets. This is a moving average. The signal here is when the moving average, the slope turns up, you get a bullish signal followed by a bull market. When this slope rolls over, that tends to be bearish. We did indeed get a bear market. Here's where it turned back up, and we did get a little bit of a run. The point is, we're getting this rolling over in a bearish fashion like we did here, which says there's probably more downside risk on this chart. Again, if this starts to turn up, that would be a bullish signal, and we're open to looking at any bullish signals if we can find them. This is an updated version of the small cap index, the Russell 2000 weekly. This is one of the moving average crossovers. It's bullish when the shorter term moving average blue is above the red line. Notice here it held. You should try to stay with this market. Bearish crossovers, bear market, bullish crossover, bull market. Moral of the story today, we've got a bearish signal similar to bearish signals that we saw in this area. Last week we mentioned we lost a signal, a sell signal on DVY. Dividend stocks went to neutral. This is rolled back over. Prices crossed below the moving average. The long-term bearish signal on the monthly chart of DVY has returned. It becomes more important if it carries into month end. This is an update to a monthly chart of the emerging markets index as of the close on September 22nd. During these corrections, the moving average never rolled over, was signaled to try to stay with this market. Here it did roll over. It was a bearish signal, went into a bear market, turned back up. There's your bullish signal. In the present day, we're getting a bearish look again, very similar to this look here where stocks, emerging market stocks fell quite a ways. Again, a monthly signal, it becomes more meaningful if it carries into the end of September. We recently wrote an article about a deflationary shift that's taking place that is bearish for almost all asset prices, with maybe the exception of conservative bonds, the dollar, and inverse positions or shorts. This chart, which is the gold-silver ratio, recently broke out. This is a deflationary and bearish signal. The point of all these charts is, as long as this deflationary signal is in place, then we'll treat it that way. We also have to be flexible. It's possible that the ECB or the Fed or the IMF could come up with something and this signal could go away. If it does, we have to be flexible. The reason why this is a deflationary signal, silver tends to have more economic and industrial uses and is more economically sensitive. So when silver is outperforming gold, it tends to be in an inflationary, positive GDP, positive growth environment, whereas gold tends to be more of the Armageddon twin of the precious metals twins, and gold tends to be more in demand when people are concerned or negative about economic growth, or they're concerned about the big picture. Deflationary signal, not good for stocks, not good for commodities, not good for silver. Intermarket relationships can give you an advantage in the markets. When you see things like the Australian dollar weakening versus the US dollar, that tends to be a bearish signal for the stock market. And commodities, especially since Australia Australia's economy is heavily dependent upon commodities. What do we see here? We've got a moving average here rolling over in a bearish fashion, which increases the probability of the Australian dollar coming down. We've got a MACD black line that's just now going under the red line. So that's a bearish signal here that frankly wasn't that great a signal. Here's a better signal. It led to that. Here's a bullish signal. Another bullish signal with a black going over the red. Bullish here. Leaning bearish. You can also notice that this blue MACD histogram, when it ticks down, that tends to be bearish, especially when it goes into negative territory. And as of the close on September 22nd, it has slightly broken into negative territory. We've shown this Bollinger Band monthly chart before. You can go back and find some of our older videos to get some details. Takeaway, cross the center line, you have a tendency to go to the bottom channel. Cross the center line, you have a tendency to go to the bottom channel. We've now retaken this center line. If the tendency to go to the bottom channel holds, that would be around 1,000 on the S&P 500 index. Another update to a chart we've shown in the past, monthly chart. On these charts, you're looking at moving average crossovers. Red under the blue is a bearish signal. Bearish signal. After the signals in the past, we had significant losses. The point here is that the signal is still in place. The important thing is that it's in place at month end, at the end of September. I want to emphasize here, all markets have counter trend rallies. This is a bear market. Huge counter trend rally, huge counter trend rally, huge counter trend rally. So if we talk about the S&P 500 index coming down eventually to 1,000 or maybe even all the way down below 700, there are going to be numerous counter trend rallies that make you feel like any bearish analysis is wrong. And that's just the way markets work. They make it very, very difficult to try to make money on the bearish side of the market or the bullish side of the market. This is a monthly chart of crude oil, and you may say, I'm invested in the stock market. Why do I care about crude oil? Well, you should care about crude oil because it can be a leading economic indicator. Obviously, there's more demand for crude oil when the economy is stronger. Takeaways here, monthly chart. When RSI on a monthly chart broke 50, we had a bear market. In the subsequent bull market, RSI tended to hold the midline. Here, we've broken through it, and it looks more like a break that we had here. MACD, bearish cross. We just had a bearish cross. Histogram, negative territory. Prices went down after that. Histogram, negative territory. Here, slow stochastic breaks the center line, losses follow. In the subsequent bull, it holds the center line. Higher highs followed. Here we've broken through, and this is also a bearish divergence. The indicator's making a lower low, and price has made a higher low. That's a bearish divergence. Have a similar divergence potentially here since we're higher. Come down to CCI, breaks the center line, negative implications from a probabilistic perspective. Above the center line, bullish implications. Here, we broke the center line, and you'll notice in the summer of 2010, we held. So this is another bearish divergence. If I put a trend line here, it slopes downward. This trend line slopes upward. Bearish implications from a probabilistic standpoint for crude oil longer term. There's always going to be counter trend rallies. To show the scope of the problems, we're quickly going to scroll through long-term bearish signals in numerous markets. Malaysia, long-term bearish signal. Canada, long-term bearish signal. Australia, blue below red says the bias is bearish. The blue just crossed below the red, giving us a long-term bearish signal. The material in this video has no regard to the specific investment objectives, financial situation, or particular needs of any viewer. This video is presented solely for informational purposes and is not to be construed as a solicitation or offer to buy or sell any security or any related financial instruments, nor should any of the content be taken as investment advice. Any opinions expressed in this video are subject to change without notice, and Shavako Capital Management, LLC, or CCM, is not under any obligation to update or keep current the information contained herein. CCM and its respective officers and associates or clients may have an interest in the securities or derivatives of any entities referred to in this material. CCM accepts no liability whatsoever for any loss or damage of any kind arising out of the use of all or any part of this material. We recommend that you consult with a licensed and qualified professional before making any investment decision.